The stores are open. Markets are rising. People go to work, buy coffee, scroll through screens showing green arrows. Everything feels normal, familiar. But look a little closer, beneath the surface, and something is shifted. Consumer confidence is at a decade's high for the stock market, while personal financial outlook has dropped to its lowest point since the 2008 crash. People are optimistic about Wall Street, but terrified about their own future. This is not just unusual, it is the most dangerous signal a system can send, and it always comes just before a reset. For the first time in over 30 years, something deeply unsettling is happening inside the financial system. Two measures that normally move together are now pulling apart. On one side, confidence in the stock market is soaring. Surveys show that investors believe prices will keep rising, that the worst of inflation is over, and that the economy is strong enough to support long-term gains. Risk appetite is back. Optimism is high. On the other side, personal financial confidence has collapsed. Households are scaling back spending, delaying major purchases, and reporting the lowest economic expectations since the fallout of 2008. Wages are not keeping up. Savings are shrinking faster than ever. More than half of Americans today believe they will never reach the same standard of living their parents had. This kind of split has never been seen before. What it reveals is not an economy moving forward, but a population holding on. It is the kind of psychological divergence that does not last. Something always catches up. Because confidence at scale is not real unless it is shared. The markets are cheering, the middle class is retreating, and in between them lies a gulf, a missing bridge of trust in the system itself. This is not a statistic, it is a signal. Every major financial reset in modern history began with people believing that the system still worked, right before it proved that it didn't. In 1999, retail investors believed the internet would rewrite everything until the bubble burst. In 2007, homeowners believed real estate only moved in one direction until it reversed violently. When people believe the future will be worse for them, but somehow better for the markets, that is not recovery. That is confusion. And confusion is where cracks begin. Most people are still waiting for the next 2008. They're watching the housing market, monitoring banks, tracking yield curves, and listening for the same warning signs they heard 15 years ago. They believe the next crash will look like the last one, sharp, dramatic, and deflationary. But they are preparing for the wrong war. Because this time, the bubble is not in housing. It is not in tech. It is not in banks. It is in the very thing we are told to trust most: government bonds and the currency itself. U.S. Treasuries, once considered the safest asset in the world, have turned into the most quietly dangerous. As debt issuance climbs past $2 trillion per year, the only remaining buyers are central banks and institutions forced by regulation. This is no longer a free market, it is a loop. And the dollar, still dominant globally but losing ground slowly, is no longer anchored by productivity or restraint. It is backed by velocity. It is being created faster, in larger quantities, to fund promises that cannot be paid without dilution. When the asset is the problem, hiding in cash or bonds becomes risky, not safe. This is what makes the current moment so deceptive. Stock prices are rising, not because growth is exploding, but because money is becoming less valuable. Bitcoin surges, gold makes new highs. Tech valuations stretch not from strength, but from fear. Once you understand this, market behavior shifts from irrational to inevitable. The bubble this time is not in assets. It is in the measuring stick itself. And when that measuring stick breaks, it does not just reset the economy, it rewrites the game. In the past, when markets crashed, money was the safe haven. In 2008, cash was king. The strategy was simple: exit falling assets, hold dollars, and wait to re-enter when prices hit the floor. That playbook worked because the money itself was still sound. But today's crisis is reversed. For the first time in modern U.S. history, we are facing a scenario where the real risk is not being in the market. It is sitting in dollars while they quietly lose value. While some wait for stocks to collapse, the opposite is happening. Real assets are inflating out of reach, while fiat currencies are losing purchasing power. Since late 2023, Bitcoin is up over 180%. Gold has surged nearly 95%. Even mainstream indices like the S&P 500 are up over 50%. Traditional portfolios that leaned on cash or diversified passive strategies have barely kept up with the rising cost of living. If you were sitting on the sidelines waiting for everything to crash, you have already lost. Because real pain does not always come through losses. Sometimes it comes through missed participation in a runaway shift. The middle class is being priced out, not just of homes, but of opportunity. Scarce assets like real estate, gold, Bitcoin, and even productive equities are pulling away as capital flees fiat-based holdings. This is no longer speculation, it is preservation. Inflation is not just costing more at the grocery store, it is changing who gets to own tomorrow. Smart money is already moving, not because it fears volatility, but because it understands. In an age of monetary decay, anything preserved in cash becomes brittle. When the currency burns slow, wealth does not explode, it evaporates. Wealth does not wait for confirmation. It moves early, silently, often invisibly, and by the time the public notices, it is already gone. In 2025, over 142,000 millionaires quietly relocated their capital, and in many cases, themselves. That number is projected to grow even higher in 2026. These are not people trying to escape taxes. They are escaping risk. Not market volatility, but system volatility. This is what escape velocity looks like. The point where wealth no longer trusts the environment around it and begins seeking alternatives before the architecture fails. Capital is flowing into fewer, harder spaces. Sovereign gold reserves are rising. Central banks are buying at record levels. Bitcoin and digital assets are held not for profit, but for insurance. Real estate in politically neutral zones is rising. Private equity is avoiding exposure to fiat-linked obligations. The public sees record-breaking prices and calls it a bubble. But the core of the market sees those prices as a signal. Get in now. Get out of the system while you still have time. This also explains one of the most misunderstood dynamics of the moment. Why traditional wage earners feel like they are standing still, even as wealth statistics rise. Because they are trapped inside the system. Inflation lifts prices, but not purchasing power. Wealth accumulates only for those who already own inflating assets. And for everyone else, each month costs more and buys less. This shift is not emotional, it is mechanical. When enough capital recognizes that the currency is melting, it begins to run, not out of panic, but out of discipline. And once it reaches a tipping point, the movement becomes self-sustaining. That moment is not coming. It has already begun. Most people imagine a reset as a dramatic event, a market crash, a collapse, a new currency overnight. But in the real world, resets do not begin with declarations. They begin with pressure points, quiet systemic shifts that no one names until it is too late. And this one has already started. It is in the numbers. The U.S. national debt has passed $38 trillion, growing by $62 billion per day. Interest payments have crossed $1 trillion annually, now exceeding military and healthcare spending. At this scale, debt becomes more than a burden. It becomes a policy. Everything bends to accommodate it. This is what economists call fiscal dominance, when the weight of debt controls interest rate decisions, limits government options, and forces monetary authorities into compromise. Raise rates to control inflation? Debt payments explode. Keep rates low to avoid default. The dollar steadily declines. It is the same trap every major empire has entered on its way down. Rome taxed and debased until silver held no value. Britain printed until the pound was forcibly replaced. Each believed it was managing the system until the system took over.
Today, the same rotation is unfolding. Safe assets do not feel safe. Reserve currencies no longer feel trustless. The wealth gap has reached levels not seen since 1929, all while productivity stagnates and asset inflation separates those who own from those who do not. And now, one final lever remains untouched for the moment: corporate taxes. Throughout history, when inequality peaked, governments raised corporate tax rates to rebalance wealth, and with it came pain, market declines, profit compression, capital flight. But also, reset, a rebalancing that does not warn you first. That lever is still sitting on the table, and history says someone eventually pulls it.
Every generation is given a decision point it does not realize until it is gone. This one comes dressed as normal, markets rising, jobs available, life continuing. But underneath the surface, the foundation is shifting. The rules that define stability, low inflation, strong dollars, predictable returns, are dissolving in real time. What used to be considered safe no longer protects. What was once called risky is now where money hides. And for those paying attention, this is not about fear. It is about timing. Real resets move quickly when they breach public awareness. They become self-fulfilling, too expensive to reverse, too far along to fix. Asset prices respond faster than narratives, and by the time the average person understands the change, the opportunity to respond has already narrowed. Owning the right assets before the shift is not a strategy, it is survival. There is no announcement, no headline that tells you when it begins. There is only a moment, quiet, unclear, where positioning becomes destiny. And for most, that moment is now. The question is not what happens next. It is, will you still be watching when the window closes?